Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Another fine day. Market's been kind of interesting. A lot of shifting going on beneath the surface. That's kind of interesting to me anyway, because big part of my day is filled with scanning stocks and putting them into the actively managed portfolio that I manage on a discretionary basis. Discretionary means I'm actually thinking about it. And by the way, I do that with a very small amount of the money that I manage because in the long run, it's incredibly difficult, very time consuming. And if I got hit by a bus, there would be nobody to take my place because I don't know anybody that thinks exactly the same way I do. And that's kind of key. I mean, when you're investing money, you have to find those types of strategies that fit your personality. And I know a lot of people think this is just a bunch of mumbo jumbo. It's not. You'll be more successful if you invest in strategies that you like and understand. And you're not all going to like the same things. And there's more than one way to do this. There are lots of ways. Very important that you find ways that you think you like. I'll give an example. One of the models that I run, this is one that I'm not thinking about. Okay, I'm measuring the rate of change in a certain group of stocks. They belong to a couple major indexes. And I'm measuring the rate of change in all the stocks in those indexes, and I'm just holding the top 40. Now, every 4 weeks, every month, I'm going to go in and I'm going to look at that. I'm going to remeasure the rate of change because that's constantly changing as well. And I'm going to stay in the top 40 out of that group of stocks. I want the top 40 stocks that are currently experiencing the greatest rate of change over the past few months. Yeah. And that's a strategy. I like it. I call it my momentum model. But you've got to have a certain type of personality to be successful with that. You've got to not try to think about what you're doing or try to pick the stocks from those groups because that almost inevitably ends up costing you money. Okay? So if you really don't like the idea of that, and by the way, it is very similar to going to a horse race and being allowed to change your bet during the race. That's what I'm doing. Doesn't guarantee a win, by the way. Because when the market crashes like it did in 2007 and through 2009, that's kind of like somebody holding up a tripwire and all the horses fall. So when the whole market's going down, that's going down pretty fast. Now, when they get back up and start running again, I just go right back to the leaders. That's exactly what that strategy's like. So that doesn't suit a whole lot of people. So I've got another model that I also happen to like a lot, and it's actually almost 180 degrees opposite. And then we're going to be talking about these in detail at the workshop that's coming up this Thursday. If you haven't heard about it because you haven't been listening to the show, that's fine. Just go to bullingtoncapital.com, click on the seminar tab, and we've got a free 2-part seminar. You might not want to go to both. You may want to. You may want to just go one or the other. I don't know. But the seminar is going to be this Thursday. We're going to start early for the first part. That's at 6:30. That's for the look out for the Bull website that we're working on, and it's how I pick stocks individually, which we'll get to later in today's program. The last section of today's program, we'll talk about what I'm seeing in the market for that portion of my money that I actually think about. The other things I thought about, these other models I thought about when I was building the model. Once you build the model, then you just run the model. Of course, I monitor it. If I think I need to make a change because the market's changing, I'll make a change. But generally, they're pretty much how they're going to be for the next 5-10 years. So the model we were just talking about was the momentum model. Take components of major indexes, figure out which ones are going up the fastest, hold on to them until they drop out of that group, and then replace them with the ones that are. That's kind of simple. And again, we'll talk a little bit about that at this upcoming workshop. The other model that I just started to talk about, I call it my high dividend model. It's the polar opposite of the momentum model. The dividend yield only goes up a lot when the share price drops a lot. Okay? So it's the buy low, sell high. It's actually the exact opposite of the momentum model. Now think about that for a second. Why would you do the exact opposite things? Well, because those two ideas work better in different environments. And when you put them together, it's a little smoother. So if you've got one that's really running, I think one day this week, the momentum model was up a little over 2% in a day. In one day. The whole portfolio is up more than you'd make on a 5-year CD in a year. So, by the way, it can give that much up and more. That's actually not even the best day it's ever had. It's not even close, but nor is it close to the worst day. So, bottom line is it's good strategy. I like it. And that's the key, is I like it. So I'm willing to stick it out. The clients I have in that have a little bit of that same type of personality as I do. They like that. They like the idea. They like watching it. We also like the dividend model, because the dividend model, we know when the momentum model is not doing well and the stock market is not crashing, the dividend model is probably going to beat it. So, which is a fairly significant amount of time, actually. The dividend model will outperform. It's outperformed now for, 2.5 years. That's a long time. If we didn't have the dividends, it would be rough. I'm telling you, if we were just momentum, it would be rough, incredibly rough. In fact, I can tell you, my assets under management will be a fraction of a fraction. Large fraction, but a fraction. That'd probably be 30% lower, minimally. So combining those two has lots of benefits. It kind of smooths out the overall performance. And guess what? They are exactly polar opposites. And I get people asking me, well, how could you do that? Yeah. Well, it's a learned behavior, I can tell you that. Because if it were me, I'm just doing all momentum all the time, and I wouldn't care about the dividend model. But I actually started out in this industry more along the lines of the dividend model. That's what everybody taught. Everybody was a fundamentalist. Very few people had access to the tools we have today to be able to run these other types of models, like a momentum model. And there are a lot of other issues, but be that as it may. So we've got those two models. I have an ETF model, which is very similar to the momentum model. I'm measuring the rate of change in the ETFs. When the change rate is higher in some than others, we're going to own them. When they begin to shift places, when the others start to come to the forefront and those are starting to wane, we'll make the adjustments. It has an international and an emerging market component. So if those two indices ever do put in a prolonged move, the way they've had a tendency to do throughout history, then it'll rotate right to that. We don't have to think about it. We're just waiting for it to happen. When it happens, we'll participate. And that's how that goes. So, the bottom line, I guess, to make it a long story short, you really need to have strategies that are well thought out, that somebody's going to execute for you. And it doesn't have to be incredibly complex, by the way. The simpler models tend to do better than they do anyway. But it's hard to get much simpler than dividend yield or speed. Those are very simple. And give them a long enough time period, you'll be very happy with your results. Anyway, I got to take a quick phone call, and I forgot to give the phone number out. The number is 216-901-0945, 216-901-0945. And I've got Carl. Carl, you got a question for us?
Yes, good morning, Bill.
Hi.
A great show. Question for you regarding the overall management of my finances.
Sure.
Does it make sense for me to engage the services of a certified financial planner before I even think about investing in the market?
Does it make sense? It might. It really depends on you. The certified financial planner is trained in lots of areas. Estate planning. They're supposed to know taxes. They're supposed to know your property and casualty insurance. They're supposed to know your health insurance. They're supposed to know investing. And one of the problems I have with that, by the way, is those are all separate vocations, and those are all specialties. Okay, so one person being able to know all that, I just think it's impossible. In fact, I know it is, or at least I've never met the person that could know all that. So bottom line is, I guess, what is most important to you, and what type of, how do you think? See, do you do a monthly budget? Do you keep a spreadsheet on all your expenses?
I do. I can't say I follow it religiously, but I have an idea of what's coming in and what's going out.
Okay.
Yes.
Well, that's good. How detailed is it?
Pretty detailed. I got it down to the amount of taxes I pay on my weekly or my bi-monthly paycheck. So, I account for the federal taxes, state taxes, local taxes, real estate taxes. I mean, those are all expenditures coming
Sure.
out of your income.
Right. Okay. Well, Carl, it sounds like a certified financial planner for you. You'd be easy. You'd be kind of their dream client. But you may not need that. And one of the reasons I chose not to go down that path is that I don't enjoy doing that. I hate helping people doing budgets, because it's been my experience that people that have never done them before, you're talking about months worth of effort and to get that done correctly. So you having already done that, you're ahead of the curve. You're like way ahead of the curve. 9 out of 10 people don't do what you've done. Okay. And I think what you've done is great. I'm a generalist when it comes to financial planning. So if I were you, I would probably focus more on the investment side, because the investment side, the CFP has a couple courses in it, but they're, those guys don't manage money. They're out there picking managements from, other portfolio managers, and that's not what they do. They're more, they're exactly what they say they are. They're planners, financial planners, and financial planning has a lot more to do with, it should have a lot more to do with a lot of other things other than investing. And so you can't really you're kind of like a jack of all trades. Does that make sense?
It does. And I was just curious, do you work in conjunction with any certified financial planners, your firm?
Yeah. And actually, there's a firm that's on this radio program, the estate planning team. And they're very good. And they do that type of planning where if somebody really wants to get down into the nitty gritty, they'll go help them through that process. So I'm kind of like you are. I think most people can come up. We have a budget. In fact, if you want, I can send you a copy of it. Just email me. And anybody else listening wants a copy of the budget. It's got just about every major category and a whole lot of minor ones in there, so you can kind of get an idea of what your living expenses are. Because I run into this problem all the time. People will come in and say, "Hey, Bill, I hear you do investment advising, and I want to do a plan. How much can I make?" And okay, well, maybe we need to start with my questionnaire to find out how much in assets you have. Oh, okay. So we get the assets down. How much do you need to spend? It doesn't really matter, because I can't spend more than 6% a year anyway if you're under the age of 50. Because, there are some guidelines that a registered fiduciary, which is what we are as investment advisors, we're fiduciaries. We can't do what you want us to do if it's not in your best interest. So I have to move. I basically would have to move on. If you needed to take out more than 6% a year, then I have to tell you, you're going to have to actually go to Schwab or Fidelity, and you're going to end up doing it yourself, because they do have fiduciaries there that do similar things to what I do, and they're not allowed to do that either. So if somebody wants to do something that's not in their best interest, I'm not allowed to help them. Bottom line, there's a law against that sort of thing. So if you come in and you have a pardon me?
No, go ahead. I'm sorry.
So if you have a fairly decent idea of what you need, if you have an idea of what your total investable assets are, and all your sources of income, Social Security, a pension, maybe you have rental property, then it's really easy to put the plan together. In fact, I will release a little ebook as soon as I get around to it. It's called Just the Answers. I think the whole financial planning process is actually a whole lot, much ado about nothing. You've got assets and income. That's what you got. What are you going to do with it? What's a prudent thing to do? What type of lifestyle can you afford on the assets and income that you have? And if you're young, great. You've got a lot of time to increase those assets, which is what we try to help you do. Try to build those assets up as much as possible, given your particular risk tolerance in your style. What do you like? A lot of people hate my momentum model, so we're not going to use it. In fact, I've got another model that they'll probably like a lot better, because it goes along more in the lines of what they're trying to do, but they just don't know how to do it. And we're going to be talking about that at the seminar too. It's very similar to the dividend model, but instead of looking at the dividend, I'm looking at the actual operating income, or the cash the business is generating. And if they don't have cash, it's not making it in the model. So Twitter's not going to be there. You have to be generating cash. Now, a lot of people, when I say that to a lot of people, they say that, well, that doesn't make sense. What do you mean it doesn't make sense? Well, why should that be important? Okay, well, I understand where you're coming from. You need to hear a couple books that you might want to read these books and come back and see me. Because if you don't understand why it's important for a business to be able to generate cash as an investor, okay, you've got a ways to go. You got to get up to speed. Does that make sense?
Yes, absolutely. So all right. Well, again, I guess I was just approaching this more from concerns about estate planning, because I know that's not what you do in your business.
Right. I would say the estate planning team, they're a good one.
The estate planning team?
Yep. Yeah. I got to run. We got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Hey, that was I was asking about financial planning, estate planning, and one of the better firms I know is actually on this radio station, estate planning team in Middleburg Heights. There's more than one when you Google them, so just put the words Middleburg Heights in there, and you'll see them. And their radio show is actually called Financial Food for Thought. So anyway. I'm going to go to the phones, back to the phones now. If you've got a phone call for us, 216-901-0945, 216-901-0945. And I got John.
Happy New Year.
Hey, Happy New Year.
Hey, thank you for helping us to get another year under the belt. I don't know whether the panty's on there or not. We don't know.
Yeah.
But the belt is there.
Yep.
I tell you, it's a very unusual situation developing in the sense confirmation of the office transition. It won't be ready for one thing. It looks like it. With all is there a possibility I could start a company on conflicts and then IPO for that, so we can bet on those, how it will be resolved in the next reality show for the next 4 years?
Well, this is America.
The worst enemy of capitalism is uncertainty. Let's face it. Now, America's dollar is the reserve currency. Nobody even talks about it. Apart from the imbalance, the trade imbalance and everything. But nobody talks about the fact that we are still superpower, super currency, still, with all the problems, things work out somehow.
Right.
Count the blessings. Right. But somebody said, I'm going to privatize Jenny May, Fannie Mae, all the May. May should be, and should be may, it should be should. That means all of a sudden individual stocks go up. And 140 characters, Twitter may be losing money, but we should buy stock in that. How is that?
Yeah, I don't know.
See, policy light, we were always latte, everything is light, dilute.
Right.
Sure. We always have no fat-free. Somewhere along the way, I think the last at least 15, 20 years, maybe even more than that, Glass-Steagall, of course, was the starting point. I have nothing against Wall Street people coming and becoming treasury people because they know what's going on.
Right.
If I want to be a shepherd, I should at least know what the sheep looks like. You know what I mean?
Yeah. Yeah. Right.
So it's sad, some of the things we've been doing in capitalism. It has helped around the world, whether we like it or not, whether we notice or not. It has built up the standard of living.
Right. Yes, it has.
Globalization has, there is no medicine without side effect.
Right. Absolutely.
But somewhere along the way, the policy level, this is the worst transition. I'm 81. I've never seen transition with the policy level so light. Some of the things, 50 states were supposed to be laboratories, including territories, if you don't want to include them.
Right.
And Romney Care was there before Obama almost, even so his oath of office. And now, all the laboratories, I can't find any excepting some acid.
Right.
Somewhere.
Yeah.
It's a shame. If I were, I would have pushed the thing and let Obama vote and veto. They didn't do that. They won an election for the 6 years, an excuse. Now, all of a sudden, we are finding out, 6 blind people and 1 elephant. Of course, that elephant is the Republican Party.
Right.
And it affects the finance. And, of course, a couple of companies are doing well with the dividends. And the external factors do affect, world factors affect, and we can always have China being blamed or Russia being blamed. Somebody has to mind the store. The last 4 legislature, House especially, the least productive since World War II. Of course, who wants to read about history in this country? We don't want to do all that. We should know who was the World Series and what was the innings. I'm sorry. You see, I was not even born here, and I happen to be interested in finance and capital, mostly because I had a wonderful boss who went to school with Papa Bush, and he made a few millions before he even hired me years ago. He passed away, and then I went to teaching and volunteering since '78. It's sad what I've seen because we are literally
I got to tell you,
capitalism. But I'm not a pessimist. I don't want to go to old days. I don't want to polio either.
No. And I'll tell you,
the good work.
Well, thanks for calling. And,
keep up the good work.
Yep. Have a good weekend. And I got to tell you, lots of things happening. In fact, I should mention the workshop we have coming up on Thursday rather. New year, new year, new president, new risks and opportunities. There are opportunities out there. There are actually kind of a lot of them. So the wild card, it's Trump. We don't really know. We don't know what he's going to do yet. And who knows? We'll have to watch. And I can tell you that we've had presidents that were a lot worse than him. The difference is we didn't have the internet. And it is kind of fascinating to watch this whole thing unfold. And we're going to talk about it in detail. I've got some things to bring up, changes that are occurring. That's one thing that you can absolutely count on. That change is going to occur, good or bad. Okay? It's going to occur more quickly in the next 4 years than it has in the past several years. Change is going to happen relatively quickly. And there's a lot of reasons for that. It's not just because Donald Trump is the president. It's because we've got a Republican Congress. We've got a Republican Senate. And believe me, there are a lot of smart people in there. And things are happening. They're movers and shakers. The administration so far has an awful lot of people who've got an awful lot of experience getting things done. So it'll be interesting. It'll be really interesting. And people still worry too much. That's the world's always been coming to an end. That's an old song. I remember that there was a guy, he just recently passed away. And his last name was Ruff, R-U-F-F. And he wrote these books on rough times, and he had seminars and how the world was coming to an end. And you want to talk about making a lot of money selling fear. And that's generally, that stuff has not gone away. It's all moved on to the internet. See, when you put out a headline and you attract readers to your website, Google will place ads on your website. And when people click on those ads, Google gets paid and they split the money with you. So think about that for a second. I've gotten a lot of stuff from some people who say, the real news, there's fake news. Yes, there's fake news everywhere. Everywhere. There's always been fake news. It's a little easier to create fake news today than it has been in the past, because in the past you had to have a printing press. Today, all you need is access to a public library, which are free, by the way. You can walk in, start using their computers for nothing. So anybody can post anything, anywhere, at any time. And if it catches on, lots of people, lots of eyeballs see it. And it must be true, right? I saw it on the internet. Yeah. So it's that part that has changed the way everybody lives now. And I'll tell you some other changes that have occurred, that have been actually slowly occurring. The stock market today is not any more volatile than it was in the early 1900s. It's not. In fact, it's more similar today than it was to the late 90s. It's more similar to the early 1900s than it was in the late 90s or the 80s. Stocks will move faster today, just like they did in the early 1900s. They're a little bit more volatile on a day-to-day basis than the stocks were in the early 1900s. Early 1900s stocks would take off like a shot. They would run and run and run. They'd have a deep correction, then they'd turn around and run back up again. It was a little bit smoother if you look at the chart than they are today. Today there's a lot more noise. But having said that, stocks will make a move today, 2016, 2017. They'll make moves now that used to take a year, and they'll do it inside of 6 or 8 weeks and turn around and give it back again. So there's an opportunity there for the people who are slightly mathematically, competent. It's called an opportunity factor. And the number of opportunities is significantly higher, but you have to move much more quickly. And if you don't, you're just going to be out. So it's one of the reasons that the models work so well. When you have a model, say the dividend model, I'm going to take largest 500 stocks in the country, or even the top 1,000, doesn't matter. And I'm going to break them up into the major industries or major sectors that make up the stock market. And I'm going to buy the 4 with the highest dividend yields in each one of those. I just described my dividend model. That works very well, or at least it has worked very well, knock on wood. But I understand why it works. When the share price drops and the stock pays a dividend, the dividend yield goes up. Think about that for a second. Think about that actually while we take this phone call. And if you'd like to call us, 216-901-0945. And I got to go to Daryl. Daryl, how you doing?
Good morning. It's wonderful. The sun is shining.
Yep.
And you sound terrific today.
Thanks.
I was wondering, if I may ask you, the current climate in the economy, how do you think it would allow, and how easy it might be to get people to start a new business? With employment being at reportedly low rates, or actually employment being at high rates, unemployment being low, and the stock market doing relatively well, do you think that might affect my ability to get people to be interested in starting a new business?
I don't think you're ever going to get people to want to start a new business. That's impossible. If they don't already want to start a business, you're not going to get them to develop desire to start a business, because most people know how tough that is. So what you have to look for are people who are open to the idea. They're already looking for something to supplement their income with. Mm-hmm. That's what you need to look at. Stop trying to convert people. Start looking for the ones who are already looking for it. That's a key. Every good marketer knows that. The crappy marketers don't. I shouldn't say the crappy. I should say the successful marketers know that. You've got to go with the people who are already looking for a solution. So if I were marketing a business, and I know what we're talking about here, and I think it's a good opportunity, but you've got to find the right person, somebody that's actually looking for something. And that's where things really start to click. And even though, unemployment has dropped fairly significantly, I don't know anybody that feels like they're making too much money. Not a single solitary soul do I know who feels like, man, I'm getting paid too much. So, they've all got and there are opportunities out there. And, we'll get together and talk more about this too. I even have to step my game up a little bit. I've just been working on a lot of things at once. It's been hard to put up much time. So, but anyway, I would focus. And incidentally, the fastest growing segment of the population is 62 and over. Every day, 10,000 people turn 62. In the country, only 1 in 5 households can put together $100,000 of investable assets. Half of them are over the age of 65, by the way. But so we've got the same problem we had when I started in this business 30 years ago. Nobody's teaching this to the kids when they're 12 years old before their hormones kick in. Because once those kick in, you can't talk to them until they're 30. But you've got to get them before the hormones kick in and show them how much cash it takes to be able to quit your job and live off the investments that you've accumulated. It takes an enormous amount of money, and saving is hard. So starting a business like the one that you're talking about that has a residual income, is it easy? No. Is it possible? Yes. Does it have residual income? Residual income is income that you get whether or not you decide to get up out of bed that morning.
I love it.
And it does. So, I just have to keep plugging and look because I know they're out there. It's actually just reaching them.
Yeah. Well, I kind of knew that. I just was looking for an opinion from somebody that's a little bit outside of my industry. Yeah. So thank you for that.
All right.
And might I mention the website that we'd like people to take a look at?
Yeah.
Sure. It's amysminioffice.com.
Yep.
AMY, amysminioffice.com. And there's a free video that they can look at and evaluate, no pressure, and we'd be happy to answer any questions for them that we can. We've been doing this for 35 years.
That sounds good. Hey, I heard the music. We've got to take a real quick commercial break. Listen to Bill Bullington. I'll be back.
Bill.
Yep. Have a good one.
Met up with a gambler. We were both too tired to sleep, so we took turns staring.
And we're back. Hey, I'm going to devote the next 15 minutes to the stocks that are going to be showing up on the Lookout for the Bull website. We are almost ready to launch that sucker. Been a long time, and it's going to be fun. So I'll devote at least 20 minutes every show, because this is something that I like to do. I do it for a very small fund that I run. And I only do it with about a third of the assets in that fund. So the fund's relatively small, and I'm doing this with about a third of the assets. Now, the other two things I do are very similar. Actually, they're identical to some models that I run for regular clients. My dividend model and the model I'm going to be talking about at the upcoming workshop on Thursday. If you haven't signed up, you might want to get there. You can go to bullingtoncapital.com. We're going to have a 2-part seminar. The first part is going to be talking about the things I'm going to be talking about in the next 15 minutes. The second part are it's the new year, new president, new risks and opportunities, how we plan to try to take advantage of those. So I would I encourage you to go to that website, bullingtoncapital.com, and sign up. There's no cost to attend. Seating is limited. Actually, they got 31 seats room, and that must be lucky because I had the number 31 for a lot of years when I played football in Pee Wee, high school, and college. Anyway, the should be a lot of fun. They do a very good job putting out nice refreshments there, the whole 9 yards. And again, there's no cost to attend. So let me get back to. I just lost my whole train of thought there. Sorry about that. Let's go back to the stocks that we're going to be talking about on the Lookout for the Bull website. See, I encourage everybody to learn about trading stocks. Now, I know some really important people in the investment world have held negative opinions of this for a very long time. I can tell you that there are a small percentage of people that have done very well trading. And I'm not talking about day trading. I'm talking about I hope I can hold on to something for a year. It's rare that ever happens because stocks generally don't move that smoothly over an entire year. Normally you'll have a couple big corrections. Sometimes one every 3 or 4 months. But the stocks generally don't put in long, extended trends like they used to. It's what I was talking about earlier in today's show. Stock will make a move in an extremely short time period and then turn around and correct. Here, let me give you an example. Here's a company called Box, and it's very similar to Dropbox. They came public not too long ago, actually. It's an online storage company. They've got some big corporate clients. If you go to their website, which I believe, I'll double check for you. I believe it's box.com. Yes, box.com. Go to their website. You can see what they do right there. And it's kind of like when you hear people talking about the cloud, they're one of those cloud companies where you can store documents. You can, if you store your pictures up there, if your computer blows up, it's all backed up in the cloud. You can just get another cheapo computer and log in and pull up the stuff that you were just working on. It's highly secure, all that other good stuff. Okay. So this stock actually comes public in 2015 and gets right around $24 in price. Before the end of the year, it's at 10. Comes out at 24 and goes down to 10. Wonderful first year, right? Anyway, it bounces up off that bottom, and now it looks like it came up on one of my scans. It's symbol is Box, B-O-X. Price is $15.05. Let me tell you how it came up on the scan. Came up on the scan because it was up more than 3% in one day. And over the past 90 days, it's actually in the top 10% of all stocks since it made that bottom. Actually made the bottom in January. It looked like it had made a bottom in October. Then it bounces a little bit. Then it goes down even further. Finally bottoms out. But if you look at the over the past few months, past 3 months actually, this has been one of the top performing stocks. It's in the top 10%. It's also up 3%. Also closed in the top 25% of that day's particular range, which is important. And it had 125% of its average daily volume. What does all that stuff mean? Well, this is a strong stock that's getting stronger. And that's about all you can ask for in a stock if you are looking to make money sooner rather than later. So if you're looking to make money on something that'll go up relatively soon, you should probably look at those stocks that are going up right now, which is essentially exactly what this stock is doing. Is it going to keep going? I have no idea. Yeah, I don't know. If I knew that, I wouldn't have to work. And I think people would be incredibly shocked to see the number of small losing trades you'll have. Emphasis on small. The number of small losing trades, most people that do make money trading for a living, it's basically how they do it. They take a lot of small losses and occasionally they get a big win. And that big win wipes out all the losses, puts them in the black. Those are the successful ones. Okay, the successful ones, it's kind of like a batter in baseball. If you can successfully connect in 3 out of 10 at bats, okay, 3 out of 10 at bats and you successfusly connect, you will be paid millions of dollars. And this is very similar to that. And it used to be, I used to have to watch how I talked about this because people had such bad inclinations towards people who were trading. But anyway, when I look at Box's fundamentals, which incidentally, you wouldn't necessarily have to look at. You don't have to look at a company's fundamentals, things like sales, profit margins, all that kind of stuff. Because you're probably not going to be in it long enough for that to matter. I know a lot of people who don't look at that at all. I still do, by the way. I still think it has an impact. This company has a 4.8 price to sales ratio, and that's enough to scare an awful lot of people away. But I'm here to tell you, for a software stock and for a company that has a gross profit margin of 67%, that is not bad, especially when it's growing by 30% year over year in revenues. How many companies do you know who are doing millions of dollars in business that are growing by 30%? That's what I'm saying. There's this has got everything that you could have in a stock. Now, watch, as soon as I buy it, I'll probably get stopped out of it. I don't care. If you keep taking shots like that, eventually you're going to hit one and you're going to get all your losses back and then some. So that's just the way it works. And it's fun. So here's another one that came up, and I actually own this one already. I have to disclose that if I own a stock and I talk about it on a radio show. I've got to talk about it. Box is up big over the last 6 months. I didn't. I was looking at a different type of chart. But that stock could double. Okay, I'll come back to that later. If you have a question on it, just email me. So here's one, a company called Square, another technology stock. Square is one of those things that makes a little thing. It's in the shape of a square. You stick it in your cell phone, and you can open an account with them, and you can sell stuff and take credit cards. How cool is that? So you can take credit cards. Square's also growing very fast. They're not very profitable right now. I mean, the net after tax profits are not very large, but they're growing fast. They've got a good gross profit margin. I mean, think about it. Those devices, they get made in China. They can't cost them more than a few bucks. And you get 2 to 3% on every transaction for everything you sell. Well, that's what you're paying them. I take that back. That's what they're getting. So they've got a very good business model. Very good business model. Accept payments, get paid. How simple is that? Okay. So the symbol is SQ. I already own it. I have to tell you that, but it came up again on the scan, which you'll see happen time and time again. Come to this workshop on Thursday, and I'll go into this in more detail. But if you have any other questions, you can email me, Bill at Bullington Capital. Thanks for listening here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good investing, and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.